In this short video, we're going to go over some of the highlights for the DSCR loan for investors in Texas. Anyone that has questions can visit us 7 days a week at DSCR Loan Source or simply call us at the number there. DSCR loans, also known as debt service coverage ratio loans, that can be a valuable tool for real estate investors that are purchasing both short-term or long-term rental properties. This program has many benefits that it provides. We're going to look at some of those here real quick and then talk about also some of the drawbacks. The main benefit, of course, with this program is that it does not require income documentation in order to qualify. That, of course, is one of the main drawbacks with your standard conventional bank loans, is that they do have income and debt to income ratio requirements that are in place like any standard mortgage. That can oftentimes be a hurdle for many self-employed investors, especially. So again, with DSCR, it's not about your income. Really what they look at is the coverage ratio of the property and the buyer's their credit score. Those are really the main two components that are reviewed. Is again the coverage ratio, which we're going to look at here in one of the next slides. DSCR also allows for an unlimited number of properties. This is great for investors that want to quickly scale their business. Many of the conventional or conforming loans, they limit the number of financed properties you can have. It can vary, but generally they limit that to 10 properties. DSCR does not have a limit. The program is also good for investors that need to refinance out of maybe a short-term hard money loan, or investors that not only want to just refinance the rate and term, but also cash out of a short-term hard money loan. Many conventional loans, of course, they have a 12-month seasoning requirement before you can refinance or cash out any equity for the loan. So DSCR does not have that as well. First-time investors, they are eligible with the DSCR. Investors, of course, can close in the name of their LLC or corporation. Again, often not permitted with conventional loans. This is a big benefit, really, for many reasons. For really liability reasons and also for tax purposes. But that's also one of the benefits. Single family homes, most condominiums and multi-unit properties are often eligible for financing. And again, this applies to both short-term, your Airbnb type properties, and then of course, long-term rentals. Again, the debt service coverage ratio, the calculation is the big thing that lenders really focus on. The coverage ratio is simply just simple division by calculating or dividing the net operating income by the total debt payments. Lenders typically like to see the DSCR around 1 or above. Generally 1.25 or above is considered a good coverage ratio. We do have options that are available for negative cash flow or negative DSCR options. So that is also available. It's important though also to note when you're formulating your DSCRs in your mortgage payment, it should only include really the principal, interest, taxes, and homeowners insurance, and then of course any homeowners association dues if they're applicable for the area. Property management fees, normal utilities, things like that would not be included in the formula. But again, anything really 1.25, anything above that is considered a good coverage ratio. This is just a quick calculation. An example, let's say a real estate investor is buying a rental property in Dallas. Monthly rental income is $3,150 per month, and their monthly loan debt is $2,500 a month. Again, simply divide the numbers and you get a DSCR in this case of 1.26, meaning the rental property generates 0.26 more that is required to repay the loan. So that is good. The higher, again, the DSCR, the less risk it is to the lender, Therefore, the better terms and lower interest rates that are going to be available to the borrower. Higher DSCR also just allows for greater flexibility. Um, Again, in the terms of the loan, there are interest-only options that are available and down payment options. Generally for the purchase loans, the down payments are 20% or more. But again, a lot of that depends on the risk factors with the loan and most importantly, the actual coverage ratio. We want to go over just some of the drawbacks for DSCR that investors should be aware of. Again, this only applies really to rental properties. It's not geared towards primary homes. Non-warrantable condos, with some lenders that can be really a case-by-case basis, depending on the scenario. These loans all have a prepayment penalty or an early payoff penalty. Uh, that is one thing that your conventional type products generally will not have. With DSCR, the prepayment or early payoff penalties are generally 5 years, but there are options to reduce that and to buy that down lower to maybe 3 years for a prepayment penalty. Interest rates, they are typically higher when compared to your conventional type mortgage. Typically maybe 1.5, 2 points higher, depending on the credit of the borrower and of course many other variables involved. DSCR kind of fits, it's probably not as low as a conventional loan, but it is certainly a much better option than maybe a short-term hard money loan. But again, the main draw though with DSCR is that there is no income documentation requirements for the program. Investors do need to have cash reserves. This is the amount of documentable income reserves that they have left over or remaining after they pay their closing costs and their down payment. The number of mortgage payment reserves, that can fluctuate depending on many factors like the coverage ratio and credit and things like that. Generally 3, sometimes up to 12 months of reserves can be required. Gifts, though, are allowed for reserves and to document reserves. That's a basic rundown and the highlights. If any investors have questions, again, please reach out to us by calling 888-502-1825 or visit us at dscrloansource.com. Thank you.